Welcome, everybody. My name is Mina Jane, and I am one of the programming librarians at the Cary Library. So good to see you this morning. Hope you all had a good Thanksgiving. I am here to introduce Inessa Manning, who's going to be talking about investing, the basics of, which are so important to all of us. But before I do that, I do want to thank the Cary Library Foundation for supporting all of our adult programs. And Inessa is actually the president of our foundation. So I was really, really pleased that she was able to take the time to do this. So Inessa has done two other programs with us that you can find on our YouTube channel on savings and what was the second one? Savings,
budgets, and then the second one was savings. So the first one was budgeting, second one was savings.
Awesome. So yes, you can find those on our YouTube channel and they're really, really good. I will be monitoring the chat. If you have any questions, just put them in there and I will ask Inessa as we go. Feel free to unmute yourselves and ask as well, or at least after the presentation. So without further ado, I'm going to hand it over to Inessa, who's going to tell you a little bit about herself and what she's going to be talking about. Welcome, Inessa.
Thank you. Thank you so much, Mina, and good morning, everyone. So a little bit about me. So I am the president of the Cary Library Foundation, but I also have about 20 years professional experience in financial services, in the financial services industry. For the majority of my career, I was advising institutions. So companies, corporations, money management funds. And then over the years, as I got older and encountered issues in my own life and my friends and family began asking me questions, I became increasingly interested in issues around personal finance. It sort of connects both those financial basic concepts, but it's also intertwined with sort of people's lives and challenges, and I found that intersection really interesting. So I earned my certified financial planning certificate a couple years ago. I spent a brief time practicing at a local community bank, and then actually stepped away from that. So I'm not currently affiliated with a broker dealer or a financial firm, not trying to pitch any product, so I'm unbiased in that regard. But I would have to say, when putting these slides together, I found myself kind of infusing it with my own personal investing philosophy and sort of the way I've encountered financial problems before. So that's definitely, you can't take that out. That's definitely infused in part in here. As Mina said, we've done a couple of other programs. Our first one was focused on budgeting, and then we focused on savings. So this one is now focused on investing. It's definitely a basic overview about sort of how to get started, but I'm happy to answer questions. So as Mina said, feel free to type those into the chat at the bottom of your screen. And if we don't have time today, or if the topics are ones that we can dive into in more detail, maybe we can make these programs for 2021 to address. So definitely, as I'm talking, if you have questions or thoughts, feel free to contribute. So we'll dive right in. So I just flipped to the second slide. So you should all see what the definition of investing is. So it basically means to commit money now with the expectation of gaining back more money in the future. But I'm going to stress that word expectation, because it's an expectation, it's not a guarantee. So you're hoping that you're going to be earning money on your money and you're going to be getting back more. But there's certainly a risk of loss that exists in any investment. And that's important to recognize up front. So you do not want to be investing with money that you need to provide yourself with food and shelter. That's not your investing assets. You want to be investing with excess, with anything left over after paying for your basic necessities, because that risk of loss is very real and does exist. There's some common ways that people begin investing in the market. You may buy a bond or a stock, or invest in a mutual fund, exchange traded funds, sort of buzzwords that you might have heard. And then for the vast majority of us, I think people begin investing through their employer-sponsored retirement plans. So there are all different ways you can kind of get involved in investments. I think as you start out, or even if you've been investing a while, you want to ask yourself, What kind of investor are you? So it sounds a little trite, but I think this is really important to do because you want to be matching up the type of investor you are, the type of financial investments that you want to make against what products you're investing in. That has to go hand in hand. So the very first thing, and if you've ever worked with a financial advisor or have set up a brokerage account for yourself, is you're going to hear this word of what is your risk tolerance? And that's I've always felt like that's such an amorphous question that's really hard to get your hands around because so what do you mean by that? Am I a risky investor or am I a conservative investor? Maybe I'm comfortable taking risks in my personal life to some extent, but do I really want to risk my money? That can be hard to get your hands around. There's certainly a lot of online quizzes out there that you can take. I have a link up here to one. You don't have to write it down. Mina's going to pop that into the chat so you can see that later. And it's nothing fancy. It is just a PDF. It's about 20, maybe 25 questions, and you have to score it yourself at the end. But I like this one because it kind of gets at some of the nuances. It sort of sets you up with some decisions that you have to think through. So this is one of the more thoughtful ones that I've found over the years that's available. And so you want to assess that. You want to go through a risk tolerance assessment. At some point, and then maybe check in as time goes on and sort of reconfirm that that's really where you are with your comfort level of taking risk on. So that's really important. Another thing that you want to think about, though, it's more than just what your risk tolerance is. It's also sort of what's your nature in terms of investing? Do you have the appetite, the comfort with monitoring an investment on a regular basis, making sure that the market hasn't changed or the company hasn't run into financial problems? Or do you prefer to kind of invest your money and then just kind of back away from it, set it and forget it, I think is the phrase that I came up with. So if you're preferring to sort of set it and forget it, then you definitely want to be investing in a fund, leaving that day-to-day management up to a professional. But if you're okay with the frequent monitoring and making sure you're understanding what's going on in current events and how that might impact your investment, then individual stocks and bonds might work well for you. So there's sort of those two approaches, and you need to understand where your nature is, what you're comfortable with. Also, a very important component of sort of evaluating what you want to be investing in is your time horizon. So if you're going to need access to your funds in a relatively quick time, within the next year, you're not going to want to invest in anything that's too risky. A perfect example of that is what happened to the market in March when our current healthcare crisis kind of kicked off and how the market plummeted. If you had some money invested in the market that you needed for maybe a down payment on a house or something of that nature, it would have been really difficult for you because the market plummeted. But if you could afford to wait that out and see you kind of have things rebound and you could wait to today, you will have found that the market has recovered from that point. So the longer time horizon you have, the farther out on your own risk scale that you can go. So that's important to realize. And you might have different risk tolerances for different buckets of your money. So that's something to keep in mind too. And then the final thing I would throw out there is your personal liquidity is going to play into what type of investor you are. So if you have more disposable income, you might be so inclined to be a little riskier with a certain portion of that than if you don't have much disposable income. So all of those are factors that you're going to want to look at. What is your risk tolerance? What is your investment style? Do you want to just invest it and put it away, or do you want to be monitoring it? What is your time horizon? Yeah. And then what is that personal liquidity? Was there a question? I thought I just heard a voice.
No, I think that was just a little feedback.
Okay, no problem. I'll move on. Okay, so this presents a typical investment pyramid. So at the top there in nice bright red are your risky investments. So options, futures, collectibles, cryptocurrency. Certainly, I'm not going to advise anybody who's here with us today to begin investing in those. At the bottom of the pyramid, jumping down, is that nice green bar, cash and cash equivalents. Those are your safe investments, your low risk investments. And then in between, that blue and yellow area are where most of us lie as investors, as we might be investing in money market accounts, in CDs, and then moving up that scale, we might be investing in stocks and bonds and mutual funds. So that's where most of us lie.
Something else. I need a representative.
Sorry. And so I think as you move up, as you move up that risk pyramid, the higher risk investments are typically ones that do have a potential higher return. But you need that ability to sleep at night. It's a little tongue in cheek, but you don't want to take more risk than you're comfortable with. And so that's where the slide that we were just talking about is taking that time to make an assessment of where you fall on the risk scale is really important. And again, recognizing that you might be able to take on different amounts of risk for different buckets of money, and matching that up with the different products, investment products that are out there, where they are in terms of their riskiness. So this is that typical risk pyramid. So basically investing in the equity market, that becomes more risky. Keeping your money in cash in a bank account, that's safer, but you're not going to get the return just keeping your money in the bank. You're not making money from your money. Okay, so we're going to move on to diversification. So basically, don't put your eggs all in one basket. You do want to be diversified in your investments. If you invested in one company and that company goes bankrupt or suffers a sudden loss, then you're going to find yourself without your money at the end. So that's the importance of diversification. One way of achieving diversification is to utilize a mutual fund or an exchange traded fund, an index fund. Those are the different types of funds that are available to retail investors or investors like you and I. And so that's one way of achieving diversification. But you should be aware that not all funds are totally diversified. If you're investing in a mutual fund that, let's say it's a mutual fund that focuses on blue chip equities, then you might be diversified in that basket of investments, but you're still invested in the stock market. You're not also invested in different types of assets like bonds or real estate. So you want to look at your total assets, the total assets that you have, and you want to make sure not only are you diversified in terms of the number of stocks that you might be owning, but also in the type of assets that you own, and that will be stocks, bonds, real estate, is sort of those common buckets. And you want to make sure that you have diversity in between those various asset classes. Just sort of one more moment on diversification. There's a lot of academic research out there about what achieves diversification in the stock market. There's, I think the primary study says that if you're invested in 30 different stocks, then you're diversified across the market so that your investments will probably produce the same return that the overall market does. And then there are some academics that will argue no, diversification is more stocks than that. Maybe it's as high as 60. And then you'll get other academics that will say, no, actually it's a lot less, it's 10. So kind of in that range of, I would say around 30, if you own 30 different stocks, the return that you expect will be about the same return as the overall stock market. Okay, so you're ready to get started. You know a little bit about investing. So how do you do so, or where are you going to be investing? So first is retirement accounts. And those are usually made available to people through their employer. You want to make sure that you are maximizing your contribution to those accounts, because your contribution will come out of your paycheck on a pre-tax basis, and then grow on a tax-deferred basis. So you're putting off paying taxes on that money, and that will earn you more money on your money at a later time. So you want to maximize your contribution to any employer retirement accounts that you have available to you. So you want to do that for you, first of all. You also want to make sure that you are maximizing any employer matches that you're eligible for. So if you are investing in an employer retirement account, sometimes, not always, but some of those accounts will provide a match of maybe 3% or 4% of your contribution. So if you contribute 3% of your salary, your employer then would match that 3%. So if there's a match available to you, you want to make sure that you're utilizing that so that you're not leaving it on the table. That's really important. I also threw up here healthcare savings accounts. This is kind of a particular area, so I won't sidetrack us here, only to say that these are increasing in popularity. There is a maximum amount set, so this is never going to fund your retirement, but this can be helpful if you have a healthcare savings account available to you. This might be something helpful to explore. Other places that you can get started in investment is through a brokerage firm. So there's so many brokerage firms out there. There are ones that have been around a while, such as Fidelity, Charles Schwab, Vanguard, and then there's a lot of new ones as well. There's sort of this big shift with technology and finance that's going on in the world right now, and so there's a lot of new online firms that are popping up. And I say online, some of the more established players like a Fidelity or a Charles Schwab, they also have brick and mortar locations. So you can go in and talk to a person live and face to face. But that's sort of the primary way that's a non-retirement account mechanism for getting involved in investment. You can be self-directed in your investment, so you can buy and sell on your own through their trading platforms, or you can work with an advisor. There are also robo-advisors, which is kind of, as the name might tell you, it's an automatic, a technology-infused way of you enter in your information online, and then the automation will tell you, well, this is how I think you should be investing, and will automatically, in some cases, even readjust your investments. And those are called robo-advisors. And there are firms out there that do that. There's some of the more established firms also have robo-advisor features in them. It can be almost overwhelming to know where to get started. Just one place that I have up here is NerdWallet. You might have seen their advertisements, which are a little bit funny sometimes, but they do have a lot of good information up there, and they do a pretty good job in reviewing the different players that are out there. So if you're looking for a brokerage firm to be working with for investments, I would start with some of their reviews and lists to help you narrow down the fit that seems like it makes the most sense to you. Another sort of where somebody might start investing is through inherited money. So money left to you by somebody else. Again, this is sort of a specific area, so I'm not going to spend a lot of time with it now, but I'm happy to take questions. But there's certain things that you should know if you're inheriting a lump sum that will impact taxes for the estate and for yourself. And sort of impact some decisions that you might be making in terms of investing that lump sum that you've inherited. So if anybody's finding themselves in that situation, we can talk about the specifics at the end. All right, so you're getting started. So what are you going to invest in? So sort of one straightforward choice is individual stocks. I put fractional shares with an exclamation point here because I actually think this is sort of an exciting area that's pretty recent, where if there's a stock that's worth maybe of over $1,000 a share, let's say, it used to be that you needed that amount of money in order to buy it. Now places like Fidelity and other online, other brokerage firms are allowing you to buy a slice of that. So sometimes it's called fractional shares, sometimes it's called slices, but they would enable you to say, I want $25 worth of that particular share. So for a young investor starting out, that's an interesting investment option to be able to have access to a company with very highly valued shares that didn't used to exist. That's something pretty new. Another idea for individual stocks, so of course you can work with your brokerage firm to buy them. You can also do something called a direct share purchase plan through a company called Computershares. And that's actually how I started investing way back when I was first out of college. And back in those days, Computershares didn't exist, or it wasn't accessible to a personal investor. So I actually invested directly with the company whose shares I was buying. Computershares now facilitates that. They're commission free. The company whose shares you are buying might be charging a fee, but it's typically lower cost than working through a brokerage firm. So that's interesting for somebody starting out, as you kind of save on fees there. Another way of another product to invest in are bonds, individual bonds. Interest rates are at a low and have been at a low for a while and might be at a low for the foreseeable future. So the attractiveness of investing in bonds, it can be a more conservative investment choice in investing in the market, but the return might be not as high as it used to be. But I would just kind of park that concept there, that you can invest in individual bonds through a brokerage firm, either on the as those bonds are issued and or on the secondary market, so after they're trading. If you are going to be investing in bonds, you want to look at this concept called laddering, where you're investing in bonds that are maturing at different dates. So you're protecting yourself from interest rate risks. So that's an area of interest. Again, it gets technical pretty quickly. Happy to dive into that a little bit more, but we'll leave that here for the moment. But likely for the vast majority of you, you may be looking at mutual funds or exchange traded funds as a way to invest. Both of these, so there's mutual funds, there's index funds, which is sort of a type of mutual fund that would invest with the aim of producing a return that is tied to the index that they're tracking. And then there are exchange traded funds, which to all extents and purposes are very similar to a mutual fund. It just, the buying and selling of them happen a little bit differently. Exchange traded funds and index funds typically are less expensive, involve fewer fees because they're not being actively managed. But you do want to be knowledgeable if you're investing in a fund about what the fee is that you're being charged. And you also want to, there's many different types, even with index funds or an exchange traded fund, there are many different slices of the market, many different industries that are concentrated in, many different size of companies that are being invested in. So there's sometimes an overwhelming number of choices. But that is typically the way that people will become involved in investing is through that fund channel. All right, so how do you evaluate this? As I was saying, there's so many different investment choices out there. It really comes down to doing your research. Even if you're the type of person that wants to set it and forget it, at the end of the day, I truly believe it's your money and you want to be informed about where your investments are going. So there's some free sites out there such as MarketWatch, Yahoo Finance, Motley Fool, that have good information, particularly if you're interested in a particular fund or stock. That can be a good place to type in the ticker symbol of the stock or the fund that you're interested in, and you'll receive a lot of information on if it's a fund, who the managers are, what their performance has been. If it's an individual stock, you'll also get the consensus earnings estimate. So that's sort of what professional analysts think about the future of that company. So there can be a lot of good information available through those sources. There's also a lot of information available through your brokerage firm, even through your bank. Banks are often affiliated with brokerage firms as well. There's a lot of good information that they produce. I have Jim Cramer listed up here. So his style can take a little bit of getting used to. He's a fast-talking New Yorker, but he gives a lot of really great information. So if you're just starting out, I would recommend tune into his show. Watch it for a while. You're going to learn a whole lot about both individual investing and then just the market overall. That's going to be really informative. So that's another source available for you. And then moving into kind of paid services, Investors Business Daily is a great resource. They have information about the market, about individual stocks, about funds, but that is a subscription-based service. And then there's also Morningstar, which professional investors use, and Carey Library has a subscription to that service. So if you really want to go in deep, Morningstar is a database, an online database that the librarians can help show you how to access if you're trying to take a deep dive into investing. So a lot of information out there. It can feel overwhelming. I would say you start with a little, and you're going to get more comfortable with things the more you read. So the more you read, the more you listen, you're going to begin getting more comfortable with the material. Okay, so when should you start investing? Well, it's really as early as possible. If you're just starting out, just try to make sure that you're maximizing any contribution that you're making to your employer retirement plans that are available to you. What I also did, like I said, I had a direct stock purchase plan set up. I had that set up to it was a small amount, $100 a month, but it was automatically deducted from my bank account. So I didn't think about that money as part of money that I had available to spend. And therefore it was just, I was sending it on and it was being invested, and it built up nicely over the years. So really get started as early as possible. But I would also say it's never too late. So if you haven't started investing and you're feeling like, oh no, I'm too late to the party, no, just sort of begin tomorrow, or once you're ready. So it's not too late to begin with your investments, but you do want to begin as early as possible. And that's going to pay off over time. I would also say here in terms of when is if you are dealing with a lump sum, so either you've been out of the market or you've inherited a lump sum of money, don't plunge it all in all at once. Don't try to time the market. The market all the time is going to be subjected to unexpected shocks. We can look back to March and sort of the shock of the current healthcare crisis. You can look back to the credit crisis in 2007, 2008. There's always going to be an external shock that we're not going to be able to predict. So certainly don't try to time the market. So if you're dealing with a lump sum of money, instead set up a systematic investment plan. So take the amount of money that you want to invest, divide it by 12 or 24 months, and invest that amount per month over time, so that protects you a little bit from these unexpected shocks that might take place. So that would be my recommendation there. And then I talked a little bit about fees in the context of investing in mutual funds. And this is just an example to really bring home why fees matter. So this is an example with a $100,000 initial investment. earnings of $330,000 in this example where there were no fees or no costs. And in this example where there was a 2% fee on that initial investment, you could see that there is a significant amount that you did not have access to as that investor that was then charged in fees at $170,000. That adds up very materially over time. So this is a little bit of an extreme example. It has a long investment time horizon. It also has the 2% fee. That's on the very high end. You're not going to see that on your typical mutual fund, but you want to check. You want to make sure that you're aware of what those fees are that you're paying, because that really can make a difference. And that kind of brings me to the end of the overview that I have to share. I have another link here for you that I think Mina was also going to put up in the chat. This is to a resource on sec.gov, so a governmental organization, and it gives this really, it's something that you can print out, and it's a pretty good overview about how to start off with investments and what to think about. I guess I would also say that there's, if you have not invested before, you're just getting into investing now, it can sort of, all those buzzwords out there and lingo can seem a little bit overwhelming. Google is your friend. If you're coming across a term that you're not familiar with, throw it into the Google search, and you're going to be educated, and you kind of in no time at all, you're going to begin getting more comfortable with these terms. So I think that is the end, Mina, of what I had prepared. Hope that wasn't too much information all up front, but I'm happy to take questions.
Okay. Inessa, do you want to turn your slide share?
Yes.
Yeah.
Let me do that. Okay.
So I don't have any questions yet. Feel free to type them in. Like I said, I'll share them with Inessa, but I'm wondering, what would be the one piece of advice that you would give your own children if they're asking, what to do to start?
So I would say you first want to learn. So you first want to become educated. And I had that slide up with a litany of different sources. So certainly a lot of free sources, certainly some television shows that you can watch, but you want to sort of listen and read financial news and information, because that's going to give you sort of that basis before you take the first step. So that would be piece of advice number one. And then piece of advice number two is get started early. That really does make a difference later on in life because of the whole concept of compounding returns. So that means sort of making money on your money. And that is powerful, and that really adds up.
Oh, thank you. Anne asks, when you retire, how do you know when it's time to move funds from stocks to something safer?
That's a really good question. I think it depends on a few factors. It's going to depend on the age that you are when you're retiring. It's going to depend on your health outlook and kind of how long you're anticipating needing access to those funds. And it's going to depend also sort of on the amount of those funds. So kind of what I started off with saying at the beginning is the more disposable income you have, perhaps the more risk that you're comfortable taking with some of those funds. But there are a couple general rules of thumb. So there's this something called the rule of 100, which basically takes the number 100 and you subtract your age from it. And that's the percentage of your assets that you should be investing in the equity market. Now, that's a really general rule of thumb. Financial advisors would probably recommend, keeping more. A professional financial advisor might recommend keeping, if you're 60, or if you reach maybe 65. I think most financial advisors would recommend keeping more than 35% in the equity market. But I kind of like rules of thumb because it gives you a starting place to work from. So I would do that calculation and then see, based on your personal situation, would you want to move the needle up or down on those equity investments?
Okay. Sandra asks, how do you choose a financial advisor? And I would like to add to that, does the choice you make depend on your age?
Um, the choice we so I would say no. I don't think it depends on your age. I think it depends on, I think there's a few factors. So one is it's going to depend on how you want to interface with that financial advisor. Is that somebody that you want to be able to meet with in person, or is over the phone enough? Or are you comfortable with doing everything online? And I think that's going to drive the type of brokerage firm that you're working with. If you want to be able to sit with somebody face to face, you're going to want to try to figure out, okay, what are your local investment advisory firms in your area, and go from there. You open up things a little bit more if you're comfortable with with taking advice over and talking to your financial advisor over the phone, or online. I happen to think it can be really helpful to sit with somebody, face to face, to kind of go over numbers together, so you're seeing the same thing at the same time. I think there's a value in that. And so then I think sometimes it boils down to a little bit of a personality fit. So you want to find somebody that you feel comfortable with, that you feel like is taking the time to listen to you. So I think that's really important. I think it's okay too to meet with a few financial advisors. Don't just because if, let's say, you're investing with Charles Schwab and you go down to their office on right next to the Burlington Mall, and you walk in, you say, I'm looking for a financial advisor. They introduce you to somebody. If that's not somebody that you feel like you have a good rapport with, ask to speak to somebody else. You don't need to stick with whoever you're first being assigned to. And I think it's okay. I think it's actually a good thing to meet with a few different people to understand where they're coming from. You do want to make sure, and again, this is where the sec.gov website can be helpful. There is a search in there to search on a financial advisor's name and just make sure that they have no complaints that's been levied against them. So I think that's sort of a baseline search that you should do. And then you should think about too, so really at the end of the day, the financial advisor has to be compensated in some way, right? Because they're giving you a professional service, like a doctor or a dentist or somebody like that. But there are different models of how the financial advisor is compensated. So some financial advisors work on a fee basis. So they might be charging you a fee based on the size of the assets that you're investing with them. Other financial advisors might be working on a commission basis. So every transaction that you do with them, they're earning a little bit of money. And then there are other financial advisors out there that work just purely on an hourly basis, that you're paying for their time based on the hour that they're sitting and working with you. And so different companies, different organizations are going to have their financial advisor compensation set up in different ways. So you should think about that as well in selecting an advisor. So hopefully that helps. The sec.gov website also has a list of questions that you should ask your financial advisor, or when you're selecting a financial advisor that you can ask, and that's a good resource as well.
So the next question is what's a reasonable percentage fee for your financial advisor to charge? I think you sort of just went over that, but do you want to just dig in a little bit deeper?
Yeah, so that's a hard question to ask. So maybe 20 years ago, kind of that 2-3% would not be unheard of. I would say nowadays that is unheard of. That is on the high end, kind of 1%, maybe even a little less than 1%. Sometimes there's some flexibility there. But I think it is also important to recognize that your financial advisor is giving you a professional service. So they do need to be, as I said, compensated for that in some manner. So if somebody's telling you, okay, I'm going to charge you 5%, I think that's way too much. If somebody's saying they're charging you 0.5%, I think that's on the really low side, and you have to wonder, is that not compensating somebody well enough for the time that they're going to be devoting to you? So kind of, I think 1.5 kind of percent might kind of maybe, yeah, I would say kind of in that 1%, 1.5% range. But it is going to depend on the person. It's going to depend on their experience level, and it's going to also depend on the returns that they've been able to provide their clients in the past. If you're talking about a mutual fund or an index fund, those percents are going to be a lot lower because you're not getting that one-on-one advice. You're investing in a fund.
Mm-hmm. Okay. So I am curious, you keep saying professional financial advisor. So like, obviously you don't want to be like, oh, my neighbor Chuck, is really good with the stock market, right? I mean, like, are those the questions that you would see on the SEC's website that help you understand like what makes a professional versus somebody who just—
Sure, right. So you want to make sure that that you're working with somebody that has experience in the financial markets, that has experience advising other customers, that has a qualification, maybe it's education-based, like an MBA, or maybe it's a certified financial planning designation is kind of a gold standard in the industry. A certified financial analyst certification is also another criteria. So oftentimes you'll meet a financial advisor, they'll hand you their business card, and there'll be kind of these alphabet soup after their names. The key one in the industry is a CFP. So that would be a key one, as well as if they are being compensated on commissions, then they also need to be licensed. So they need to have their Series 7 and Series 63 and a couple of other designations as well. So you might see those on their business card. So you want to make sure that they're credentialed correctly. And then you also, they're kind of those two different flavors of advisors that I was talking about. So you might have your advisor that's sitting down talking to you and charging you on an hourly basis. They might not be affiliated with any financial firm, so they can give you advice across different financial products. Other financial advisors might be affiliated or likely affiliated with a financial firm like a Charles Schwab or a Fidelity. And so they will have access to a certain portfolio of products that they're licensed to sell. So there's those kind of two different flavors. If you're going with somebody who you're just paying by the hour, then the actual transaction, you're going to have to play more of a role in those buying and selling. If you're working with somebody who's affiliated, then and is licensed to sell those products and services, then they can facilitate those transactions for you. So hopefully that made a little bit of sense. I feel like I might have gotten a little off topic, but it's a diverse field in that there are different models of how people have set up their businesses when they're giving financial advice, and how they're licensed and credentialed as well. So you want to make sure the appropriate credentials are matched up with how they are positioning themselves.
Okay. No, yeah, I don't think you went off topic. It was super helpful. So I have a question, and this may be something other people are thinking about, but we keep hearing that the stock market is up, it's down, it's the best ever, it's the worst ever, blah, blah, blah. But for me, my portfolio hasn't changed that dramatically. So what is that difference? Why is that?
Well, it's going to depend on what you're investing in. So that's sort of, it's hard to answer that question kind of in a vacuum. But the market, yes, the market it moves up and down and sideways. And as individuals, you cannot time the market. A professional investor can try to say, okay, I'm going to buy low and sell high and get in and out with, in a particular time frame in a day. So to make that profit. As a retail investor, as an individual investor, you're not going to have that same access, those same systems to be able to do that. So the market has been very turbulent. It's gotten increasingly turbulent over the last, certainly over the last, short term. But even over the last, I would say 10 years, there's been external shocks and turbulence and volatility in the market. that even has organizations. So one of the stints that I did in my career is I worked in Washington, D.C. For a financial regulator, not the SEC, but a different financial regulator called FINRA. And the professional regulators, we were very worried about that. We were worried about the increased volatility in the market. So that does happen. How much that you're seeing that in your own investments will depend on how invested you are in the equity market and how risky your investments are. So the sort of the more conservative investments you might have, the more cushion you will be from some of those shocks. I think, in terms of where we are right now, the market has recovered since where it fell to in March, but there's a lot of uncertainty, I would say, for sure, about what the performance is going to be. The COVID relief packages. I think there's funding that runs out in December. Whether or not there'll be another one, I think it's a little bit of a kind of open issue in terms of how much fiscal stimulus Congress might pass, and sort of what the longer term impact of COVID is on the economy as a whole. So I think some of the confusion stems from the fact that the stock market doesn't always reflect what the economy is at that particular time, and that can be confusing.
Right, that's where I was going with that. So who I'd ask how to invest in a volatile market, because this isn't the only time that it's been volatile. And sometimes you don't know why it's going up and down the way it is.
Right. Sometimes even the professionals don't know why it's going up and down the way it is, for sure. And there can, when you think about the different shocks to the market that have taken place over the last 10 or 15 years, things are unexpected. It's always something new and different. We are not experiencing necessarily the same shock twice, but it'll be a different shock and something new. So, I think that the key is you just realizing that you're not going to be able to time the market. If you're getting into the market and you have a lump sum to invest in, set up that systematic investment plan that I was saying. So don't just turn around tomorrow and invest everything that you have or everything that you're going to want to invest over time. Split that into chunks and then invest in that on a monthly reoccurring basis. And be in there for as long a time horizon as is practical for where you are in life. So the longer time you have to invest, the more up and down of the market that you can weather. And that kind of brings us back to that question about sort of knowing when to get out. That's a really hard question. It's very difficult to know when to make that exit. So again, my advice would be set up a plan, kind of understand where you want to be, kind of have that end game, and then don't just sell everything at once. Just kind of set up a plan to slowly, methodically sell over time, if that's what you're doing, if you're trying to exit the market.
Mm-hmm. Okay. So this is maybe slightly off topic, but for people that are retiring and are, going to access their Social Security, because that's sort of money that's been invested for us, supposedly, over time, right? So what would be your advice on accessing Social Security?
Well, there's no particular advice other than, I guess, so you have some decisions to make. So you can decide whether or not you're going to want to take Social Security early. And I think you can do so as early as age 62 or at your normal retirement age. And that's going to depend on the year that you were born, or late. So the later you take Social Security, the more monthly Social Security payment that you're going to be receiving. You really have no other control. That is your only control with Social Security is are you going to take it early, take it on time, or take it late? If you take it late, you get a little bit extra. If you take it early, you get a little less. And if you take it on time, you get the amount that's been set aside for you over the years. My recommendation is that if you can afford to wait and take it late, that typically is beneficial. But there might be situations where you do need access to the money early or on time, and those choices are available to you too.
Okay. So what if you run into an emergency situation where you need to take money out of an account that is like a money market where you have like a time frame where you're supposed to keep it in for that long, a certain amount of time?
So if I don't believe maybe there is a money market account out there that locks your money down for a little while, but typically that's not the case with money market accounts. But it typically is the case with a certificate of deposit or
Right.
CD that has a certain maturity date. So if you do need access to those funds, typically you can get it. It's not like it's locked away from you forever, but there will be some kind of fee or penalty that you need to pay. And that is going to depend on the terms of that particular investment. But if you truly need access to it on an emergency basis, you need access to it. I would say that that's where that knowledge comes in. You should be aware when you're making that investment what that fee would be, so that you have that in your thought process as you're evaluating. Okay, I need access to these funds. Okay, it's not going to be $100. It's going to be, $95 that I'm going to get back. To know that ratio in your mind is helpful.
Mm-hmm. Can you speak a little bit on annuity investments?
Annuities, that's a great area, and maybe that's a topic for a future conversation. I would say, you sort of briefly here, there are many flavors and types of annuities. There are fixed annuities that's going to pay you out a certain amount. There are fixed deferred annuities that pay you out a fixed amount but at a later date. There are variable annuities that will pay you out an amount depending on how the performance of your investment has gone. There are equity indexed annuities. There are all sorts of different annuities. So this is a pretty deep topic. So it's impossible to kind of say annuities are good or annuities are bad. What you might have read about before is that annuities can be associated with high fees. And as we saw from that example, fees do matter in terms of investment returns. So certain types, not all annuities, typically not fixed annuities, but a variable annuities can have high fees associated with them. There can also be a variety of different add-ons that you can get to these annuities. They're basically, they're insurance contracts. So it's a contract between yourself and an insurance company. You can have the annuity payment be paid across your life. It could be paid to you during your life and your spouse's life. So there's some choices that you can make there. There can be minimum guaranteed periods where the payment is made for a certain number of years, like let's say 10 years. And if you die in year 5, your heirs will get those future year payments. So they really become in a lot of different flavors. One thing that I've always been frustrated in, honestly, is that there's no, unlike the stock market, where there's a sort of a centralized database that you can get access to that's going to show you all the stocks and how they're trading. There's not one central repository of all annuities. So it's hard to compare apples to apples. And if you're working with an investment advisor, they're going to be licensed with certain insurance companies. So the insurance products that they're showing you, not that they're not great, they might be exactly what works for you, but they're going to be the products that a financial advisor is licensed to sell. So that they might not be the full universe of everything that's out there. So annuities is, I could go on, but it's kind of a specialized topic. Maybe if the person who asked that question, if they had a specific follow on, I'm happy to take it, or maybe that becomes a topic of a future session.
Just wrapping up our little webinar.
Oh, sorry. Okay, I think that wasn't for us. So Inessa, thank you so much for being here for this. This is so interesting and really helpful. I did want to say that Inessa is working on a program with us, so save the date for January 5th on taxes. We haven't gotten it completely together yet, but we will soon. So thank you so much, Inessa, and thank you everybody for being here and your questions and for listening. I will send out a recap later today with the video and the links. So have a wonderful day, everyone. Inessa, thank you again. And, it's a pleasure working with you always.
Oh, thank you. Thank you. And also, if anybody has suggestions for other topics that they're interested in terms of financial education, let Mina or I know as well, because maybe we can fold that into a future program.
That's a really good idea. So yeah, during the recap, if you guys want to send me any ideas, I would really appreciate it because we can't think of everything, right? All right. Have a wonderful day, everybody.
Thank you all.